So welcome to the Investor Water Hub Speaker Series for December. And for those of you joining us for the first time, my name is Monica Freeman. I direct the Investor Water Hub and the investor research at Ceres, really assisting institutional investors on doing better water risk analysis and mitigating water risks. If you also are joining a Ceres call for the first time, Ceres is a nonprofit based out of Boston. We've been working for over 30 years to really drive more sustainable investment management practices and corporate practices related to climate, food production, water, and a number of governance issues as well. So welcome to the webinar. So before we kick things off with our great guest speakers coming on board, just a couple of logistical items. Because it's a fairly large webinar, we have put everybody on mute, but we do encourage very much discussion and questions at certain points of the webinar. So if you have any, you can either type them to your questions in the bottom left of your screen, or you can raise your hand by clicking next to your name. And at certain points, we'll stop and take questions at any point. So please do ask those questions. And we're hoping this particular topic will stir a lot of good ideas and questions as well. Before handing off to our speakers, just a reminder, this is a call of the Investor Water Hub, which is a working group of Ceres' larger investor network. And the team that is absolutely invaluable in all this work is not only myself, Monica Freeman, but Hugh Brown and Robin Miller, who runs the speaker series. And as a reminder, the Investor Water Hub has collectively just recently launched the Investor Water Toolkit, which is an online resource, and also now in PDF and tear sheet form that really guides investors on the methods and where to go for data and analysis on doing better water integration analysis in portfolio management. And as part of the Investor Water Hub, we have a number of smaller working groups and opportunities we wanted to share briefly. The first is that there is an investor sign-on opportunity. There is a global set of investors that are collaborating and really engaging large fast food publicly listed companies on supply chain risks related to water and carbon in their supply chains. And so Robin Miller, my colleague, is leading that work and collaborating with FAIR out of the UK. And there's an upcoming deadline of January 18th for any investors who'd like to join that collaboration in that work. So please do reach out to her for more information on that really impactful engagement with companies. We also have, and what is really linked to this particular webinar, we have two smaller working groups of the Hub also working on portfolio water footprinting. So if anyone's interested, please reach out to my colleague Hugh Brown or anyone on the team at Ceres. And the other one is really, we've just kicked off a group called Water Materiality and TCFD Physical Water Risk Analysis. So this is a working group that's really looking at how to better measure the financial materiality of particular types of water risk and really do better physical water risk analysis related to the TCFD recommendations on climate. So without further ado, one of the working group members is actually Matt Coleman of Nephila Climate, and we thought this topic in particular was really useful for that work and the work overall that investors and others are trying to really analyze in terms of really understanding the business case and the financial risks related to water. And these speakers are really going to dive in and bring some fresh thinking, really drawing from the fields of weather data modeling, insurance, and what are the lessons learned from those fields and the analytics and the data sources that they are going to that really can be useful for investment managers as well. So we have two Matts on board, so Matt Coleman and Matt Stein from Jupiter Intelligence. So Matt Stein is the VP of Business Development, and Jupiter Intelligence is a relatively new firm, very exciting skills and analysis, really looking at asset level data-driven risk analysis that can be anywhere from 2 our time frame to a 50-year time frame, so doing some really interesting and innovative work. Prior to Jupiter, Matt was an entrepreneur and founder of Multitude, an air quality sensing and analysis startup. He also worked at GE for many, many years in their data ecosystems and digital platform as well. And previous to that, he was also working with Prudential real estate investors as an analyst. So we're excited to have Matt Stein on board. And then following Matt, we'll also have Matt Coleman of Nephila Climate. And as I mentioned, Matt has been an invaluable member of Ceres Investor Water Hub and has placed a lot of really interesting ideas, especially in our metrics, maps, and tools section of the toolkit, if you're interested to hear more of Matt's ideas. But at present, he's also Director of Strategic Partnerships for Nephila Climate. And Nephila really looks to sell and create financial protection to corporates and governments and investors that hold risk related to weather and water variability. And that spans sectors from energy, agriculture, water services, infrastructure, transportation, among others. And Matt also has previously worked at Citadel and the National Center for Atmospheric Research. And he has a very exciting background of having both a degree in finance and meteorology. So wouldn't the world be better if we all had that combination of background? So without further ado, though, I welcome Matt Stein from Jupiter Intelligence to dive in more deeply and talk about the work that he is driving at Jupiter. Matt?
Great. Thanks so much, Monica. We appreciate the opportunity. There are a couple trends that form the backdrop of our talk today. Trend one is really this idea of broadening the definition of water risk based on climate science. As you're all aware of the risks of water as a resource in your companies and portfolios, my guess is that over the last couple of years, you've also been thinking about the business impacts from acute flooding and chronic trends like sea level rise, known in TCFD parlance as physical climate risk as opposed to transitional risk. Trend two is really the ability to understand water risk at a much more granular level based on new technologies. You've likely seen tools that provide a somewhat quantitative, although mostly qualitative view of water risk. These tools can be helpful to quickly scan or screen assets in company facilities. And it's worth noting, as Monica mentioned, that Ceres has compiled a great set of recommended tools in its investor water toolkit. But we agree with BlackRock that taking data to the next level of individual structures is truly critical to quantifying risk. What I'm going to talk about today is the idea of facility and sub-facility climate data and how that enables new levels of risk quantification and business decision-making. This will be particularly important for organizations like corporates or private equity firms that are analyzing place-based risks. There are three important components of managing water volume risk at the facility level. First, water as a critical input into the supply chain of that facility. Secondly, water hazards like flooding that impact property and business operations. And lastly, impacts on external infrastructure that the facility depends on. Clearly, insurance plays a role in mitigating away some of these risks. Engineering firms also play a role designing and building resiliency, like flood defenses or moving electrical systems to less vulnerable locations. In the second part of today's talk, Matt Coleman from Nephila will highlight a third tool, weather risk transfer, which can also help smooth out some of the increasing financial variability stemming from water and climate. Before we do that, though, let's take a look at some of the new data capabilities that are emerging around assets and operations and external infrastructure. I'm going to walk you through a couple of case studies in the New York City metro area, first focusing on data centers. This is an example of publicly available data to assess flood risk in global portfolios. It's based on historical data, so it does not incorporate changes in the climate. And as you can see, there are two risk levels in this region, high, which is in red, and medium to high, both based on historical flood counts from 1985 to 2011. By comparison, viewing an undisclosed location within this domain and take a look at Jupiter data. Assume we have here a portfolio of 7 data centers, which are the circles in the middle, in this location. Notice as well the 2 diamond-shaped water infrastructure facilities, a treatment plant and a pumping station that the data centers rely on. Here we are looking at a 1% chance flooding event, which is the combination of storms. I'd like you to notice a couple things. Even in this relatively small area, there is a wide variability of risk profiles at these 9 facilities. Flood exposure here at a 1-meter resolution. Secondly, it's not just about the water on the ground at the facilities, which directly impacts properties and operations. It's also about the water on the ground around the facility, which has indirect impacts on operations. Now let's see what happens when we fast forward to just 12 years in the future. In 12 short years, things have changed. I'll flip back and forth a few times just to give you a feel for how. In 2030, our data center portfolio now has a higher average risk score, and certain facilities risks have increased faster than others. Additionally, notice the water treatment facility to the north is now more vulnerable. What's happening here from a technology standpoint is that we are downscaling climate model data, running storm data through surge models, and coupling that to advanced hydrology models, all underpinning those thousands of climate-based, cloud-based scenarios with changing sea level rises from a regional standpoint and storm intensification. In this particular case, we are looking at a high sea level rise scenario, which would equate to IPCC's RCP 8.5 business as usual, with accelerated ice sheet melting, which has been gaining increased acceptance in the scientific community. Let's look at another case. Here we have an electrical substation along a river in a harbor near an ocean. In 2020, a 1% chance flooding event has the potential to create some significant damage in addition to cascading impacts throughout its service territory. 30 years later, the picture isn't pretty. This case study underscores a couple of things. First, the importance of mitigation investments and insurance for this facility today. Second, the importance of having a modeling technology that can simulate the impacts of various resiliency improvement designs, essentially running a large number of what-ifs. Because as we like to say, the moment you put a shovel in the ground, your facility's flood risk changes. Underpinning all of these maps that I showed you are billions of data points. These points can easily be visualized in numerous ways that are helpful, for example, for property developers. Here, developers who are increasingly thinking about climate risk might look at how flood depths on the left plot or flood extents on the parcel on the right plot change over time. They may overlay critical thresholds at certain points on the property on the left plot, making these analyses even more relevant for them. This is becoming a more important element of property due diligence, which then naturally feeds straight into design and engineering decisions. Similarly, certain geographic areas are seeing an increase in tidal or nuisance flooding due to sea level rise or land subsidence, which can slowly and silently erode real estate values. On the left plot, notice the blue line, which shows about 6 days of flooding per year in this particular Miami location. but shifting to almost 300 days per year by 2040, just 22 years from now. Like in the prior slide, the right-hand plot shows the extent of nuisance flooding on this particular property. Now, seeing this, consider how banks holding 30-year mortgages in this location feel about this trend, especially as the data becomes more available. As Jupiter works with clients trying to quantify climate risk, we've noticed a few things. First, every client has a different risk tolerance. They care about different risk thresholds over different time horizons and incorporating different climate scenarios. Secondly, detailed facility data is a critical input into accurate vulnerability assessments. Third, Jupiter's hazard data needs to be coupled with domain-specific curves that equate flood depth to financial damage to generate loss impacts. And fourth, quantifying potential losses is a key component in setting up the decision architecture of what to do next. For example, invest in resiliency, adjust insurance coverage, add weather risk transfer, or simply divest and reallocate capital elsewhere. Here's a quick hypothetical example to hopefully drive things home. Let's go back to our data center portfolio. Each of the 7 data centers is going to be impacted differently over the next 12 years. Their exposures to water hazards will be different, which will create differing financial impacts, both operational and physical. For some listening, a 1% impact to annual OPEX may not seem material, but keep in mind that we've smoothed out acute events here, and in reality, the financial impacts would be much spikier. The vulnerability of each structure is different, as is the criticality of each particular facility within the network of facilities. Taken together, this gives us a composite score, 10 being most severe, and financial impact that can be weighed against potential mitigations to make an intelligent cost-benefit trade-off analysis. This is the kind of rigor that forward-thinking asset owners are currently pursuing, and we believe it will start to work its way into the mainstream in 2019 and certainly 2020. Clearly, this is not just about data centers and water treatment facilities. Every critical asset, be it a refinery, a warehouse, distribution center, or an office building, needs to be thinking along these lines. The specific business metrics for each may be different, but the underlying methodology is essentially the same. From a more macro standpoint, one can certainly ask the question, which cities are most vulnerable? Here we have a list of 20 cities ranked by the value of assets exposed to flooding in 2070. Of these, Jupiter is currently working in Miami and New York, with several of the others on our 2019 roadmap. From a data perspective, we hold ourselves to a high bar in terms of requirements. And as you think about climate data in general, we encourage you to do the same. It's important to get this right, as quality decisions require quality data. Scientifically rigorous and verification and validation, or as we call V&V, both of these instill client confidence in our methodology, which we found to be especially important in the insurance and financial services sectors. Subparcel resolution is important because physical impact happens at the property and subproperty level. Being a data generator and not simply a data aggregator is also important because as the modeler of every one of those billions of data points in the New York City Metro that you saw, our science team has an intimate understanding of exactly what went into those and can help our clients understand that as well. Periodically updated because, as you're well aware, the science is evolving at a rapid rate. And scenario-based because every client has a different risk tolerance, and many of the geographic areas have regionally adapted climate scenarios, like, for instance, the New York City Panel on Climate Change, that are incorporated into their regulations like building codes. Lastly, a few quick words about Jupiter. We are a startup, about 50 people across 3 offices, Silicon Valley, Boulder, and New York City. We model physical climate risk for long-term facility and asset planning and short-term operational needs. We work across various sectors, including the energy sector, insurance, financial services, real estate, and the public sector. We model a number of perils, and that list will continue to grow over time. And our goal is really to bring together the best of the science and technology worlds, as you can see from the team we've assembled on our website, to address this critical issue. And with that, I'm happy to take a few questions and then pass the microphone over to my good friend and business partner, Matt Coleman from Nephila.
So a reminder to type your questions in the box below or raise your hand. We do have one question, and Matt Stein, I'll read it off, and we can layer on as well from the Ceres side. So how do you assess water risk in a portfolio invested versus index benchmarks, where the constraint leeway for investment is relative to benchmarks, and how do you integrate better investment decision-making water practices? Any thoughts or recommendations on that? That's a big question, but any thoughts or recommendations there, and then happy to layer on.
Today, the way we think about this issue, I'll give you an example to try to drive it home. First, from a geographic standpoint, we have a number of coverage areas, right? So we look at New York City, we look at Miami, the Carolinas, Houston, and we'll be starting services in Europe next year. So a lot of the portfolio analysis that we do today is really based on a geographic area. So for instance, working with the mortgage industry to look at, say, 100,000 properties in Miami and 100,000 properties in Houston. That's an example of how we're working today with companies. In terms of looking more broadly at portfolios, from a geographic standpoint, we will be essentially opening up a geography per 6 weeks in 2019, and then looking at a geography every 3 weeks in 2020. So it's really about scale for us. At a certain point, we're in a much better position to be working across global portfolios. Today, a lot of the work that we do is more on a regional basis. I hope that answers the question. If it hasn't, I'm happy to clarify any of that.
Yeah, feel free to layer on if a little clarification from the question asking side if needed. I would say as well from Ceres' perspective, answering that question in terms of how do you do better portfolio level risk analysis, my colleague Hugh Brown is now doing beta testing for creating a public platform for doing portfolio water footprinting, and so that working group is evolving how to do better portfolio level risk analysis that will then lead to better deeper sector-specific or region-specific appreciation of water risk. I think too in the toolkit, one of the recommendations for some advanced practices is to really understand where you may have at the portfolio level clustering of geographic water risk exposure. So if a number of your oil and gas companies, maybe food sector, or if you have some fixed income exposure in particular cities, you may find across different portfolios or asset classes, you actually are fairly regionally exposed to particular, let's say, areas of New York or the southern U.S. where there may be kind of high water risk regions or watershed basins, and then really understanding how those holdings can, if you mitigate risk in one, it actually can help mitigate risk in the others as well. So that type of analysis can also be very helpful. The other question before we move to Matt Coleman, so we also have, how about the water risk valuation related to the customers of the companies or the real estate you investigate. So are they assessed or affected by the same water risk?
So we are currently working in the real estate sector, and I'll give you an example of how they're thinking about this and maybe extrapolate it to a couple of other industries as well. Real estate really thinks about this from a couple of different lenses. One, as I alluded to in the talk, is acquisitions. To the extent that a lot of real estate companies are now starting to, consolidate an ESG council, one of the components of that is certainly looking at new properties. We've worked with a couple of companies now for site assessments, and this is becoming increasingly an important question to the extent that they're going to be, in many cases, holding this particular asset for 20, 30, or more years. So they really want to gain some comfort, and certainly their investors would like them to have a methodology that they use when assessing new properties. The other thing that we've seen with real estate is that to the extent that certain REITs or real estate developers have large regionally concentrated portfolios, they're certainly thinking about the vulnerability of that portfolio over time. So if anyone on the phone is familiar with the term average annual loss, which is very common in the insurance industry, that's one of the primary ways that insurance rates are set. With this kind of data, we're able to essentially project AALs out into the future and see which of those properties has average annual losses that increase at rates higher than others, which is a bit of a red flag. It tells the owner that they need to do something about those properties and not just let insurance continually charge a higher and higher premium over time. That may not make sense. So it, again, sets up the decision architecture on how to think about that. We've certainly noticed this trend in other industries as well. I'd highlight the energy industry, working with a couple of large industrial firms in that sector. They're calculating the AAL and how that changes over time from a risk perspective is much more complicated. As you can imagine, there are a lot of pumps and motors and just really vulnerable points within any industrial facility, and that really requires the work of an expert. So their company like Jupiter would team up with a company like Exponent, as an example, to really understand at a site level, what is that risk and how might it change over time. Just like we do with a firm like Marsh Risk Consulting, as an example, in the real estate space. So that's sort of how we think and what we've seen in terms of real estate and some of the other sectors.
If I could ask one more question, and then we'll hold the other questions till the end. So if you just answer quickly, Matt, the data that you are collecting, are you using satellite data? If you can speak a little bit to the sourcing.
We are. There's a lot of sources of data that we use. We use certainly publicly available data. We've got a lot of folks from our team from places like NCAR and NOAA and so forth. We use proprietary data that is often the property of the client that we're working with. We use data that belongs to the city that they've shared with us, or maybe open data from the city. And we also obviously use things like satellite data, other observations that, in particular, going back to one of the slides that I talked about, verification and validation, that's a really important aspect of what we do, and oftentimes satellite data can be very helpful in terms of verifying the results of our models, so we can continually tune and tweak them to be better and better. So that's just a couple of quick thoughts, but happy to go into detail at another point.
Thank you, Matt Stein. So if we could turn it to Matt Coleman, please, from Nephila Climate.
Thanks very much, Monica and Matt. I'm happy to give you an overview of how Nephila Climate thinks about these risks. And the perspective that we're coming from is loosely described as coming from the insurance risk transfer perspective. As I walk through this, you'll get a sense through a couple of case studies how we use an analytical process to gather information and data on water volume and then quantify linkages to financial risk. And ultimately, the reason we're doing this is because we're selling financial protection against varying weather and water conditions when they're bad for business or operation. At Nephila Climate, we have 4 main product areas where we sell financial protection: renewable energy, energy markets, agriculture, and climate resilience. And the different economic stakeholders that buy protection from us, which include investors, corporates, governments, they're using these products to hedge financial risk broadly. And in addition, also to protect the livelihood of citizens, increase the bankability of project finance or other investments, or to adapt to climate variability more broadly. What's interesting is we heard a lot from Matt Stein about how damage to infrastructure is a key economic risk. There are many additional risks where property or assets aren't necessarily damaged, but earnings fluctuate nonetheless. Just like interest rates, foreign exchange, currencies, commodity prices, weather and water conditions are another external risk whereby the variability of it alone can impact financial performance. Some examples that all of us on the call have seen in some way, shape, or form. Agribusinesses, like the top headline here. If there is a drought that impacts crop production, farmers buy less farming and agricultural products, which impacts earnings and credit ratings of different agribusinesses. Multi-year drought in California a few years ago highlighted a lot of susceptibility of water services entities like East Bay Mud in the San Francisco Bay Area, where they had to implement a very large rate hike on their customers. This was confusing for customers who felt they did their part by conserving water during the drought, only to see their rates go up afterwards. And this tool of raising rates is one way to deal with water volume risk. Another, of course, is to quantify it and potentially transfer it, where the overarching problem is that water utilities have very high fixed costs to run all their infrastructure, but they have very weather and water sensitive revenue that varies depending upon those water conditions. And of course, energy, there are a lot of examples there, including hydropower, where droughts, for example, can lead to different electricity surcharges for customers and purchasers of electricity. When you think about water risk as a broader framework, it of course permeates different parts and corners of the capital markets. The forms of risk that we may see can be infrastructure, like we've discussed, business interruption, even market-wide impacts on the price and supply and demand for different goods and services. The presence or absence of different volumes of water can directly impact and cause these risks. These span a variety of sectors, a variety of time scales. We often sell protection anywhere from for next month or the next season, across multiple years out to 5 to 10 years. And different risk management strategies can certainly involve avoidance, simply determining whether or not I want to invest in something or divest from something. Once we start quantifying the underlying water volume risk, however, we can have more tools in our risk management tool belt. Do we decide to engineer a solution to mitigate against water volume risk? Do we decide to retain the risk because we're comfortable with the amount of dollar risk we hold? Or is that too much risk and we decide that we want to transfer it to some third-party financial institution? And these different stakeholders can really vary between investors, lenders, corporates, governments, the insurance sector, all of whom hold this economic risk that's linked to weather and water variability. And the process that we generally follow is to first gather the water volume data in the location of interest, quantify the variability of that water, looking back across multiple decades of history, then quantifying the financial linkages of that often publicly available weather and water data to data that we receive from the entity that wants to purchase protection. And that may be financial data or other operational data that they believe is very linked to the presence or absence of water. And I'll speak a bit more of what I mean by replicating this process for other forms of water risk outside of water volume. The first question an investor might ask is how much water volume data is available? And the short answer is a lot. A lot of the data is publicly available. Some is privately available as well for different data providers that add additional layers of analysis and cleaning and interpretation of the data. From weather stations to satellites to ocean buoys, amongst other data sources, every day that passes, there's more and more data available on water volume. We often work with data that goes 30, 40, 50 plus years into the past for variables like river flow, snow, rain, all of which can influence the amount of water volume in a watershed that can have economic impacts for anyone with an economic or societal interest in that watershed. The next question an investor might ask is how does an investor quantify the variability of water volume over time? And it's perhaps useful to think about this through an actual case study of a hydroelectricity generator in Spain who purchased protection from us to manage departures from average rainfall levels. The exposure they're worried about is drought when there's no water to generate electricity and therefore collect revenue. The water data that we looked at was more than 30 years of daily rainfall and river flow data. The operational data and financial data that were available from the generator include energy generation and revenue. In thinking about this step in the process of water variability, this chart here is showing historical rainfall totals. So there's an annual total rainfall for each year back from the mid-'80s through the present year. And the blue line is showing that variability of rainfall totals throughout the year relative to the long-term average, which is the black dashed line. A lot of investments are planned around assuming average weather or water conditions. In reality, we see anything but the actual average most frequently. And this is showing us how there are a number of historical years where it was very wet, wetter than the 75th percentile of rainfall, or the green dashed line, and also drier than the brown dashed line, or the 25th percentile. And when we have this type of data, we can get a sense of what is the probability, what is the likelihood of being in these different wet, dry scenarios, or even departures from average or expectation. After getting a sense of what water volume risk is in and of itself, the next question becomes, how can I as an investor quantify the link between financial and water risk? And let's look at another case study that of another opportunity that we looked at with a water services provider or water utility in the U.S. state of Colorado. The main exposures to this utility are, number one, drought on the supply side, lack of water to deliver to customers. And on the demand side is a wet summer, scenarios where a lot of water use happens during the summer months, mostly by residential customers who are watering lawns and taking care of their property. When summer is wet, there's less water that's being used and less revenue for the water utility. So the data that we looked at were over 50 years of rainfall and snowfall data, both of which impact the amount of volume in the watershed of this water utility. And we also received from the water utility data on water use and volume of water used by customers and revenue, both of which were available on a monthly basis. And then once we have all these different forms of data, we can get a sense of how are they varying with each other. Is the relationship strong? Should I be worried about the presence or absence of different amounts of water when, in this case, with respect to water use and revenue? The left chart shows us the seasonality of water use and therefore revenue for this water utility. The summer months are a key period where the majority of revenue is gained by the water utility. And the right chart is showing us how water use and the number of rainy, wet days have varied over the past few years. And we see an inverse relationship here. As there are more rainy, wet days, there's less water use amongst customers. And looking at all these linkages of rainy days, water use, and revenue, we can start to calculate different metrics like implied financial exposure in dollars to varying weather and water conditions. A water utility could then, or an investor or lender to the utility, could then determine whether to retain or transfer this amount of water volume risk. And a potential index or a contract that covers this risk could very well be something like water use, an index that's understood very well by the investor or the water utility. And when doing these exercises in the aggregate, just what do we find? How material is financial water risk? We can look at that in terms of the same case study. With the hydro energy company in Spain that was exposed to a dry year, they, through their own analysis and us working with them, determined that in a wet year, their earnings can be up 35 million euros. In a dry year, they could be down 35 million euros. And so the implications to the company, to investors in the company, is that earnings can be quite volatile and move essentially in lockstep with the amount of water that's in a watershed. In the case of the Colorado water utility exposed to wet summers, we found that revenue can be as much as 10 to 14% below average, where the average summer revenue is 115 million US dollars. So you're talking anywhere from 10, 15 plus million dollars of being an amount, a delta below the expectation of the water utility. And this also amounts to a 10% average annual deviation from the municipality's budget. And from the perspective of an investor, say a lender, this can mean volatile debt service coverage that's available to pay interest on long-term loans. It can also mean that the capital of the municipality can be trapped in cash reserves that are used to manage water volume risk indirectly. It's possible that those reserves could be used more efficiently if some of the risk was transferred or mitigated in some other way, therefore requiring less cash to be held simply in a drought reserve. More broadly, Nephila Climate finds across the different sectors that we offer and sell protection against these types of risks, that earnings can fluctuate anywhere from 10% to 80+%, with some obvious sectors having these very strong high linkages like energy, hydroelectricity, agriculture, and agribusiness, to name a couple. And so if we zoom out again, thinking about this overall analytical process, a final question might be, how might I as an investor apply this process to other forms of water risk not just water volume. And as we're aware, water risks can include water volume, water quality, or regulatory risk. And the idea would be replicating this analytical process by beginning and gathering the relevant data on the underlying water risk, gathering the financial and operational data for the asset or investment or entity in question, and then quantifying the linkages between the two and determining how to manage that financial risk. Do I mitigate it? Do I retain it? Do I avoid it entirely? Do I transfer it to someone else? And so by doing these exercises of actually quantifying and putting a dollar number on water volume risk, investors can become not only more informed, but also more proactive in how they deal with that risk, either for a potential new investment or an existing investment. And with that, I thank you very much for your attention and welcome any questions.
Thank you, Matt Coleman. So please do type your questions on the left-hand side if you have either for Matt Coleman or Matt Stein. We do have another question regarding the Spain Hydro energy company example, the plus 35 million to minus 35 million impact. This is based on historical data, correct? And however, looking forward with less rain in Spain, potentially, or more variability in the next coming years, how can you then quantify, based on the data set you have? How do you really look at the future risk?
So from our perspective, where we start is what I described, where we will say just count the instances of dry years that have happened in the past 50 years. But an additional layer of analysis that we do and that others would likely consider is how do I adjust that historical data to today's climate and potentially to future climates? And one way to do that is looking at and using different statistical methods to take trends out of data. If there is a drying trend over time, we certainly want to reflect what the risk is in the context of today's climate. So the past 10 years might be a more representative view of today's risk than the entire 50-year record if there's a significant drying trend over time, for example. Then the next question becomes, how comfortable, if you're looking into the future, what is your time horizon? If it's, say, less than 5 years, then, adjusting data to today's climate can get you pretty comfortable with understanding what that risk is. As you start looking farther into the future, you'll want to consider using other forward-looking information, much like what Jupiter provides, where they're looking multiple decades into the future, which can potentially form a link in risk analysis to very far into the future, coming back to present day, and then linking that to what's happened historically to get a sense of how that risk changes from the past to today, and then ultimately, potentially into the future.
Thank you, Matt. Matt Stein, anything you want to add there about sort of linking and looking to future risk, and beyond, beyond really the real estate impact or the facility impact, and how that might be linked to actual operations as well, and revenue and earnings?
Well, yeah, I think Matt Coleman captured it great. The only thing that I might add to Matt's answer is that a lot of times what you'll find, and especially we have quite a bit of statistical expertise in-house with respect to how various climate models perform in different parts of the world. So a lot of times what you'll find is that, there's about a dozen or so global climate models that project out in time. Precipitation is certainly one of the elements, the outputs of those models. What you find is that certain global climate models perform better with respect to a lot of the observations that Matt highlighted in his presentation over time. So there's a little bit of an art and a science to this in terms of figuring out which climate models to apply and overweight in certain ensembles to understand, how these precipitation patterns will change over time in a very regional way. So that's the only thing I'd maybe add to that. But certainly in the States, there are some underlying shifting baselines around precipitation that Harvey exemplifies and so forth that we are spending quite a bit of time on.
Great, thank you. Again, if you have any questions, please type in the bottom left. One other question is regards to groundwater and the realization that in certainly many economically important areas, industrial areas, a lot of water sourcing is also from groundwater, and how much some of those aquifers that are critically important are really declining. And curious if some of your work is also collecting groundwater data, or might in the future, or of course it's very interconnected with precipitation events and recharge and so on. But if you could give some perspective on groundwater.
Sure, I can start on this one. This is Matt Stein. It's certainly a very critical area. We're doing quite a bit of work in Miami, and as you know, it's a very porous, ground. Specifically, the further south on the peninsula you get. So it is absolutely a key component into flood levels and probability of different flood levels at different times of the year. It's an area that we continue to explore. And again, I'd highlight my earlier point, which is some of these issues like groundwater tend to be very regional specific. So they become more or less important depending on which region that we're modeling.
Thank you.
At Nephila, we haven't worked with groundwater data. Not to say that we wouldn't. Generally, the problems that come across our desks are related to surface water volume. If, on the other hand, we encountered, say, a water utility or an agribusiness that clearly is seeing financial impacts that are tied to groundwater, we would certainly begin looking into data availability and how we can combine that view of water variability below ground with a view of water variability above ground in order to get a more all-encompassing view of the risk. The geographies where we've seen a lot of water risk are ones where there's a lot of links to snow and rainfall and surface water contributions to the overall economic profile or risk.
Yeah, as Matt was talking, it reminded me that, to the extent you really want to understand from a granular detail surface level water depths, in many cases you really have to, especially in urban areas where there's underground infrastructure, subway tunnels, et cetera, you really need a pretty detailed understanding of what's going on at the subsurface. Part of the work we do is with the public sector, as I mentioned. So that helps us get a little bit further down that path in terms of understanding some of those dynamics that aren't generally captured in, say, a catastrophic risk model or something like that. But it really is all of these things get coupled together to essentially, from a modeling standpoint, continue to give you higher and higher confidence, less uncertainty in the results of the model.
Thank you. One question that I actually had was, as I mentioned, Ceres is trying to really understand and do better portfolio-wide water risk analysis. And in some of our past research and working with SASB and with the Investor Water Hub members, was really trying to look at the investment indices and which sectors, seem or likely do have high materiality or high material water risks. And, not surprisingly, a lot of the sectors that came up were, utilities that you talked about, semiconductors, mining, oil and gas. Are there, if you were an investor that is burdened with looking at hundreds, if not thousands of companies, as some pension funds actually do, what would you prioritize in your opinion? Doesn't necessarily have to be official through your work or with your clients, but just with the knowledge that you do have, what would be your top 3 industries or sectors that you would really start to do research on, and then, what could be, and then from that, what would be the ways that, that risk could best be mitigated, other than, of course, it would depend on, the actual investor, but, certainly kind of buying, risk transfer could be a real no-brainer for one particular industry versus doing a particular type of investment in, capital would be really work in another. That's a lot to ask in a few minutes there, but if you have any high-level thoughts, that would be really helpful.
A couple thoughts on that. One would be, if I have a universe or portfolio of investments and I can subset those into ones that I think are exposed to water, I would then sort those, which not terribly surprising, sort those by dollar size of investment, and then start going into location-based analysis. A lot of the insights that we get from data only result when we can identify the geographic location of the largest economic amount of water risk. And so if I'm able to do that sorting of investments, identify the most material locations globally where I believe there is quantifiable water exposure, I can then start looking for different data sources on water volume, depending on my relationship with the entities or investments that I'm invested in, can start requesting data for those locations, operational and financial data, and then start going through the process of quantifying those linkages and determining, okay, now that I can estimate what the dollar exposure here is and whether or not this is a strong link to water conditions, what are my options? And depending on my time horizon, the capital I have to deploy, am I going to be pushing for more engineering solutions to this problem? Am I going to be pushing for financial solutions to this problem? Or simply decide that the risk tolerance, or the amount of risk is way beyond my tolerance, so I would just rather not pursue this investment or divest. So a couple of different ways that conversation and analysis could go, impacting decisions on how to ultimately treat that investment.
Thank you, Matt. And I would say, for further questions, please do reach out to us and we can answer your questions via email and pose them to the speakers. I did want to say before we wrap, please do join us for our upcoming speaker series on January 17th, focused on big data and AI for better ESG water risk analysis. And also a quick announcement of please do join us in San Francisco, April 29th through May 1st for Ceres annual conference, and water certainly will be very featured there as well. But I do want to express my deep appreciation and thank you so much to both Matt Stein of Jupiter Intelligence and Matt Coleman of Nephila Capital, or Nephila Climate, for their webinar, and just great work, really fascinating, and hope to hear more about these developments and your work in the future. So thank you both.
Thank you all.
Thank you.
And a reminder, we will be sending out a recording and some follow-up as well. And again, do reach out if you have any further questions or comments on the presentation. Thank you for joining us.